Let's talk about the one decision that shapes almost every investor's future more than any stock pick or bond purchase ever could: how you split your money between stocks and bonds. Most people think investing is about picking the right stock or catching the right trend. But the truth is, the biggest driver of your long-term returns isn't which stock you buy. It's how much of your portfolio sits in stocks versus how much sits in bonds. This single decision, called asset allocation, explains the majority of the difference between portfolios over time. So let's break down what stocks and bonds actually are, how their risk and return profiles differ, and how to think about combining them. Start with stocks. When you buy a share of stock, you're buying a small piece of ownership in a company. If the company grows, earns more profit, and becomes more valuable, your share becomes worth more too. You might also get paid dividends, a slice of the company's profits handed directly to shareholders. But here's the catch: as an owner, you're last in line. If the company struggles or goes bankrupt, bondholders and other creditors get paid first. Shareholders only get whatever is left over, which is often nothing. That's why stocks are considered the riskier, more volatile asset class. Their prices can swing wildly based on earnings reports, economic conditions, interest rates, or just investor sentiment on any given day. Now consider bonds. When you buy a bond, you're not buying ownership, you're making a loan. You're lending money to a government or a corporation, and in exchange, they promise to pay you back the full amount at a set future date, plus regular interest payments along the way. That interest rate is called the coupon. Because a bond is a contractual promise to repay, bondholders sit higher in the pecking order than shareholders. If a company goes under, bondholders get paid before stockholders see a cent. This is why bonds are generally considered safer and more predictable than stocks. But safer doesn't mean risk-free. Bonds carry their own set of risks. The most important one is interest rate risk. Bond prices and interest rates move in opposite directions. When interest rates rise, existing bonds, which pay a lower fixed rate, become less attractive compared to newly issued bonds paying more, so their price falls. When rates fall, existing bonds become more valuable because they're locked in at a higher rate than what's currently available, so their price rises. This inverse relationship is one of the most important concepts in all of finance, and it's the reason bond prices can actually drop sharply even though bonds are considered the safe asset. Bonds also carry credit risk, the chance that the borrower can't pay you back. Government bonds from stable countries, especially U.S. Treasury bonds, are considered nearly risk-free because governments can raise taxes or, in some cases, print money to meet their obligations. Corporate bonds carry more risk because companies can go bankrupt. This is reflected in credit ratings. Agencies like Moody's and S&P grade bonds from AAA, the safest, down through speculative grades often nicknamed junk bonds. The riskier the bond, the higher the interest rate it has to offer to attract buyers. That's the fundamental trade-off in the bond world: more risk, more yield. So now let's compare the return profiles. Historically, stocks have delivered higher average annual returns than bonds over long periods. Broad stock market indexes have returned somewhere in the range of 9 to 10% annually over many decades, when you include dividends and price appreciation. Bonds, particularly high-quality government and corporate bonds, have historically returned somewhere between 4 and 6% annually over similar long stretches. That gap might not sound huge year to year, but compounded over 20 or 30 years, it becomes enormous. A dollar growing at 10% a year roughly doubles every 7 years. A dollar growing at 5% takes about 14 years to double. Over a full career of saving, that difference can mean retiring with 2 or 3 times as much money. But that higher return from stocks doesn't come free. It comes with volatility. Stock markets can drop 20, 30, even 50% in a bad year. The dot-com crash, the 2008 financial crisis, and the 2020 pandemic crash all showed how quickly stock portfolios can lose massive value in a short period. Bonds, especially high-quality ones, tend to hold up much better during these periods, or even rise in value, because investors flee to safety when stocks are falling. This is the core reason bonds exist in a portfolio in the first place, not just for their own returns, but for what they do when stocks are falling apart. This brings us to the real heart of the stocks versus bonds conversation. They don't move in perfect sync with each other. In many market environments, when stocks fall, bonds either hold steady or rise, because investors move their money into safer assets. This is called negative correlation, and it's incredibly valuable for smoothing out a portfolio's ups and downs. A portfolio that's 100% stocks might drop 40% in a crash. A portfolio that's 60% stocks and 40% bonds might only drop 25%, because the bond portion cushions the blow. That's not just a smaller loss on paper, it's psychologically and financially significant, because a smaller loss requires a smaller gain to recover. If you lose 50%, you need a 100% gain just to break even. If you only lose 25%, you need a much more modest 33% gain to get back to where you started. This is where portfolio allocation comes in, the practice of deciding what percentage of your money goes into stocks versus bonds based on your goals, timeline, and risk tolerance. The classic starting point that many people have heard of is the 60-40 portfolio, 60% stocks, 40% bonds. It's been a benchmark for balanced investing for decades because it captures a meaningful chunk of stock market growth while using bonds to reduce the severity of downturns. It's not a magic formula, but it's a reasonable middle ground for someone who wants growth without taking on maximum risk. Another common framework is age-based allocation, sometimes summarized by the old rule of thumb: subtract your age from 100, and that's roughly the percentage you should hold in stocks, with the rest in bonds. Under this rule, a 30-year-old might hold 70% stocks and 30% bonds, while a 65-year-old might hold 35% stocks and 65% bonds. The logic is straightforward. Younger investors have decades ahead of them to ride out stock market crashes and recover, so they can afford to take on more risk in exchange for higher long-term growth. Older investors, especially those approaching or in retirement, have less time to recover from a crash, and they may need to withdraw money soon, so they shift toward the stability and income that bonds provide. This rule has been debated and adjusted over the years. Some argue people are living longer and should stay more aggressive for longer, shifting the formula toward 110 or even 120 minus age. But the underlying principle remains: your allocation should reflect how much time you have and how much volatility you can actually stomach. Risk tolerance matters just as much as age, though. Two people the same age can have very different comfort levels with market swings. Someone who checks their portfolio during a crash and feels physically sick, or worse, panics and sells everything at the bottom, is going to be better served by a more conservative allocation, even if it means slightly lower long-term returns, because the alternative is making an emotionally driven mistake that locks in real losses. On the other hand, someone with a long-time horizon, stable income, and a stomach for volatility might comfortably hold a much more aggressive, stock-heavy portfolio and simply ignore the day-to-day noise. It's also worth understanding what each asset class is really doing for you in the portfolio. Stocks are the growth engine. Over long periods, owning pieces of profitable, growing businesses is one of the most reliable ways to build wealth, because company earnings and the economy tend to grow over time, and stock prices generally follow. Bonds are the stabilizer and the income generator. They provide predictable interest payments, they return your principal at a known date, and they tend to soften the blow when stocks are falling. Neither one is inherently better, they play different roles, the same way a car needs both an engine and brakes. An engine without brakes is dangerous. Brakes without an engine go nowhere. There's also a difference in how each asset class handles inflation, which is worth understanding. Stocks, over long periods, have generally outpaced inflation, because companies can often raise prices and grow earnings during inflationary periods. Bonds, especially long-term bonds with fixed interest payments, can actually lose real value during high inflation, because the fixed interest you're receiving buys less and less over time as prices rise. This is why some investors add inflation-protected bonds, like Treasury inflation-protected securities in the U.S., which adjust their principal value based on inflation, as a way to guard against this specific risk. Diversification within each asset class matters too. Within stocks, you can diversify across company sizes, industries, and countries: U.S. stocks, international stocks, emerging markets, small companies, large companies. Within bonds, you can diversify across government bonds, corporate bonds, different maturity lengths, and different credit qualities. A well-built portfolio doesn't just split money between stocks and bonds broadly. It thinks carefully about what kinds of stocks and what kinds of bonds make up each side of that split. One important nuance: bond maturity length matters a lot for risk. Short-term bonds, maturing in a year or two, are much less sensitive to interest rate changes, so their prices are more stable, but they typically pay lower interest. Long-term bonds, maturing in 20 or 30 years, pay higher interest to compensate for the fact that their prices swing much more dramatically when interest rates move. This is called duration risk. If you think interest rates are about to rise sharply, holding long-term bonds can actually be quite painful, since their prices can fall significantly. This is exactly what happened in 2022, when interest rates rose rapidly and long-term bond funds saw some of their worst losses in decades. A sharp reminder that bonds, while generally safer than stocks, are not immune to significant losses of their own. So how should someone actually think about building their own stock-to-bond mix? Start with your time horizon. How many years until you'll actually need this money? Money you won't touch for 30 years can absorb a lot more stock market volatility than money you'll need in 3 years. Then factor in your personal risk tolerance, not just how you think you'd react to a crash, but how you've actually reacted in the past, if you have any investing history at all. Then consider your broader financial picture. Do you have stable income, an emergency fund, and job security, or are you living closer to the edge, where a market downturn combined with a job loss could be devastating? The more stability you have elsewhere in your financial life, the more risk you can typically afford to take in your portfolio. It's also worth remembering that your allocation isn't supposed to be permanent. As you get closer to needing the money, whether that's retirement, a home purchase, or your kids' education, it generally makes sense to gradually shift the mix toward more bonds and fewer stocks, reducing the chance that a bad market crash right before you need the money forces you to sell stocks at a loss. This gradual shift is exactly what target date retirement funds are designed to do automatically, slowly increasing their bond allocation as the target date approaches. At the end of the day, the stocks versus bonds decision isn't really a competition where one wins and one loses. It's a balancing act between growth and stability, between risk and predictability, between what will make you the most money over 30 years and what will let you actually sleep at night during the inevitable downturns along the way. The investors who succeed long-term usually aren't the ones who pick the perfect stock or time the market perfectly. They're the ones who choose an allocation between stocks and bonds that matches their actual goals and temperament, and then stick with it through the ups and downs, rebalancing periodically rather than reacting emotionally to every headline. Understanding how these two asset classes behave, why they behave differently, and how to blend them is one of the most valuable pieces of financial knowledge you can carry with you for the rest of your investing life.